For the people who are here for the answer to the question in thumbnail, the answer is no. But why? Let's see in this episode. Today in this episode, we'll learn about a company which was once a pioneer in its field, became bankrupt, got acquired, and then regained its former glory. The share price history of the company also shows a peculiar trend. A sudden exponential growth of more than 91 times in a small time frame and approximate fall of 70% from its peak, all in just 10 months. We are talking today about Ruchi Soya Industries, now called as Patanjali Foods Limited. Ruchi Soya has been in the business of edible oils for decades. They are the leader in edible oil and soya food businesses in India. They are the first exporter of soybean meal from India. They are also leading manufacturer of textured soya protein and vanaspati. The company plants are located at Indore, Sajapur, Narsinghpur and Mandla in Madhya Pradesh, Mangalore in Karnataka, Raigad and Nagpur in Maharashtra, Haldia in West Bengal, Gandhidham in Gujarat, Tiruvallur in Tamil Nadu, Sri Ganganagar and Bundi in Rajasthan. Since commencing its operations in 1972 till 2007, Ruchi Soya has installed various production units like Vanaspati edible soya flour, oil, lecithin, soybean extraction unit, solvent extraction plant, and increased their capacity manyfolds. During this period, the company launched many famous household products like Nutrella, Vanaspati, Sunrich, Ruchi Gold, Ruchi Sona, Ruchi Star, Avanti, Big Fat, Nutrella Proflow, defatted soya flour, etc. Acquired many companies like Ruchi Foods Limited, solvent extraction plant at Sri Ganganagar, Anik Industries Limited, installed refineries at various places in India, installed wind turbines for captive use, and many more. Ruchi Soya soon became one of the country's largest FMCG companies with a good market share and strong distribution channel. Spread over 7 lakh plus retail stores with 6,000 plus distributors and 13 refineries unit, Ruchi Soya produced about 3 million tons of oil per year. In fact, everything was going extraordinary for Ruchi Soya until 2011. In fact, it still held good profits until the end of 2015. Everything was going fine. Then what happened that the company growing at such a fast pace suddenly became bankrupt? What went wrong? Back in October 2011, Indonesia raised export duty on crude palm oil, which was the main raw material for Ruchi Soya's oil production, and their input cost soared. In addition to this, Indonesia had also cut export duty on refined edible oil, the end product that Ruchi Soya sold. Since most buyers prioritize cost of procurement, Ruchi Soya had no choice but to take a hit on the margins. They kept competing with these cheap imports by bearing burnt on themselves. Then their seed extraction business started failing. Droughts in many parts of India hit the oilseed industry. Ruchi Soya's manufacturing facilities were barely running at half the capacity. Margin kept tumbling. Further, they lost a fortune bidding on castor seeds. In 2017, the oil market of castor seeds saw a drastic decline. Ruchi Soya had invested huge sums into it only to see a serious loss. Ruchi Soya, which once was a profit generator, was now showing humongous losses in its balance sheets. For instance, as of March 2016, the financial statements projected a loss of roughly 800 crores. Further, the company's debts kept climbing new heights and stood approximately at 9,000 to 10,000 crores. Ruchi Soya made most of its money supplying refined edible oil to other consumer good companies. However, in a bid to push sales, they offered very generous credit terms to their consumers. Collecting cash became impossible, and at the end of the day, they were left with receivables to the tune of 5,000 crores, which had to be written off as bad debts. The company was also under the spotlight of the SEBI for fraudulent trading practices in the commodity exchange. Soon, they were forced to delist from the stock exchanges. Mounting losses and failing businesses caused the bank to panic, and the company was dragged to the National Company Law Tribunal in 2017 by its creditors, which included SBI, IDFC, etc., for the payment of the pending dues of approximately 9,000 crores. Unable to meet its obligations, the company announced bankruptcy and was declared insolvent. But rather than opting for liquidation, the banks which offered a loan opted for selling it to other FMCG and was bought by Baba Ramdev's Patanjali by acquiring almost 99% stake of the company and settling approximately 4,000 crores in dues by taking the loan from the same banks that have given loan to Ruchi Soya in first place. The loan was taken against the 99% shares of the company, keeping them as collateral. Ruchi Soya was relisted on stock market on 27th of January 2020 at a price of rupees 16.5 per share, and within 5 months reached its peak of rupees 1500 plus per share. It lost almost 70% of its value from its peak within just next 5 months. But did the investor get to make profits from this growth? In my opinion, no. With only 1% shares available in the market, not many investors could have easily sold their shares at these exorbitant prices. The shareholding pattern shows that the promoters had 99% of the shares till March 2022, which reduced to 80.82% by June 2022 through follow-on public offering. This was all due to SEBI's mandate for reducing the shareholding of promoters from 99% to 75% over 3 years, as Patanjali had unilateral say in operations of the company due to its shareholding percentage. The company is doing great post-relisting and its profit is growing consistently year on year. The total assets are also increasing, mainly the inventory and cash equivalents. So is the cash flow from operating activities. So this is the story of Ruchi Soya, which turned from king to pauper and back to king again. This story also tells that how depending on a single source, in the current case on Indonesia, can lead to a disastrous result. So this is all about today's episode. See you in the next video. Till then, take care.